Hello and welcome to Collin Investing. Today we are diving deep into a whirlwind of financial news, covering everything from potential trade wars and shifting interest rate strategies to tech stock volatility and the evolving strategies of major corporations. Get ready for a jam-packed analysis that will impact your portfolio first up. Let's talk about the catfish effect in the AI world, specifically concerning OpenAI and DeepSeek. OpenAI recently announced they are opening up ChatGPT search capabilities to all users, no registration required. This is a big deal. Unlike traditional search engines that rely heavily on ad revenue, ChatGPT's search function promises faster web information retrieval, parsing data in minutes. Thanks to its large language model, it supposedly understands user intent better and provides direct links to source results. Some are calling this the DeepSeek catfish effect, suggesting that, without competition, OpenAI might have been slower to innovate. Competition is good for us, the consumers. OpenAI is also making its first big push into consumer advertising, even planning a Super Bowl commercial. This shows the increasingly competitive landscape of the AI race. Even Google, feeling the heat, is now offering lower-cost models and slashing prices for long text processing. We're clearly entering a new round of price wars in the AI space, and it's all about finding the best value proposition. However, not everyone is happy with open-source AI. A few days ago, a Republican lawmaker proposed a bill that could result in up to 20 years in prison or $1 million fine for individuals downloading DeepSeek. While this extreme legislative action has been temporarily shelved, it highlights the tensions surrounding open-source AI and the potential for future restrictions. This whole situation has echoes of the wolf clause in the aerospace industry, which some argue actually accelerated China's independent space station development. It's a classic case of unintended consequences. We'll be watching closely to see if an AI wolf clause materializes, and much depends on DeepSeek's next moves. Keep an eye on the Global AI Summit in Paris, where discussions will focus on AI safety and equitable distribution of its benefits, especially through more affordable models. Now shifting gears to trade and tariffs, the U.S. Postal Service is struggling with changes to how Chinese packages are handled. Many U.S. retailers and express companies are confused, suspecting the Postal Service is adjusting its tax collection strategies. This follows an executive order imposing an additional 10% tariff on goods imported from China, including eliminating the $800 small value exemption. The sheer volume of shipments affected is staggering. In fiscal year 2024, approximately 1.36 billion shipments entered the U.S. under the minimum tariff exemption clause. The issue isn't the Postal Service itself, but rather the customs process. The question is, who collects the tariffs and who pays them? The existing system designed for bulk clearance is now overwhelmed by the need for individual processing. This significantly increases the burden on postal services, agents, and customs personnel. This sudden change has happened without much preparation, ironically. Customs might even experience a net revenue loss if the cost of collecting tariffs exceeds the revenue generated. This move impacts not only the development of Chinese cross-border exports, but also hits small and medium-sized Chinese businesses engrossed in export trade. China's response includes attracting Chinese sellers with inventory in U.S. warehouses to ship packages locally, thus circumventing tariffs. They're also establishing distribution and supply chain centers in the U.S. to mitigate the impact. However, delays and price increases seem inevitable. This is a bearish development for cross-border exports. Even with the establishment of overseas warehouses, costs are bound to increase. The European Union is also contemplating similar measures, with increased scrutiny of substandard and counterfeit products. The EU imported about 4.6 billion low-value items under €22 last year, 91% of which came from China. This number has tripled since 2024. Raising concerns within the EU. Let's turn our attention to individual stocks, starting with Disney. Their recent earnings report showed revenue and profit growth, with all three major business segments significantly exceeding market expectations in terms of operating profit. However, Disney Plus lost 700,000 subscribers, despite efforts to crack down on password sharing starting last September. The results aren't comparable to Netflix. This may be due to price increases and intense competition. On the surface, the quarterly free cash flow appears less than ideal. In reality, this is because Disney increased capital expenditures on parks and cruises, laying the groundwork for future growth. While the total number of Disney Plus users declined, the core US and Canadian markets still saw a 1% increase quarter over quarter. The company is guiding for full-year user growth in 2025. Disney reaffirmed its guidance for high single-digit earnings growth in the US for 2025, based on an expected EPS of $5.3 for 2025. The current stock price corresponds to a 20 times dynamic price-to-earnings ratio, a historically reasonable and slightly undervalued valuation range. However, uncertainty remains high, including seasonal fluctuations in the sports business, the lingering negative impact of Hollywood strikes, and potential performance pain points. The future depends on whether compelling content emerges and drives subscriber growth in the streaming business. Short term, we're watching to see if it can break through $120. Finally, let's talk about Baidu and MicroStrategy, now rebranding to Strategy. This company holds 471,107 Kaidus at an average cost of $64,511 with a cumulative return on investment of 50%. However, their quarterly report showed a loss of $670 million and an annual loss of $1.16 billion. This discrepancy is because their unrealized gains aren't reflected in the financial statements. Looking ahead, Strategy projects a 15% Python yield in 2025, generating $10 billion in annual revenue. They also stated that they are about halfway through their $42 billion Python purchase plan. Historically, their stock price has surged from $9 to over $300 due to continuous additions of new shareholders. The explosive growth in net assets per share stems from high-priced share issuances, inflating their net assets. The money raised far exceeds their losses. The key to this model's sustainability is Baidu continuously reaching new highs. Company management has been selling their own stock while simultaneously issuing new shares and debt, tightly controlling the stock price. While Strategy's approach resembles gambling, their success with billions in investment income and returns exceeding 10% has inspired imitators. 78 listed companies globally are now emulating Strategy, buying K-codes instead of holding cash. These companies span various industries, including pharmaceuticals and advertising. Some see this as a way to counter short selling, layering Pigno pressure on their stock prices. Some zombie companies are even using Baidu to prop up their share prices and distract investors from their poor core businesses. However, warnings are being issued. While everything is rosy when Baidu's price rises, a collapse would have severe consequences. Another potential big development involves BlackRock reportedly preparing to launch Baidu exchange-traded products in Europe, potentially in Switzerland. This follows the success of their $58 billion US Paigai ETF. Zeta Bank predicts Baidu will reach $200,000 by the end of the year and eventually $500,000 before President Trump leaves office in 2028. A warning from the OMO: global market volatility is likely to persist throughout the year, with tariff policies being a major driver. The global financial market turmoil triggered by a series of U.S. tariff announcements this week appears to be just the beginning of a turbulent year. The bank expects inflation and tariffs to have the biggest impact on markets in 2025, followed by geopolitical tensions. Events similar to the DeepSeek situation will also be unpredictable black swans. Now, moving on to some insights from another YouTube finance channel. They discussed Trump's economic agenda facing roadblocks in Congress. Republicans are internally divided over budget issues, stalling a comprehensive package of tax reform, energy policy, healthcare reform, and border funding. The core disagreement lies in whether to implement these measures through a single large bill or a two-step approach. Senate Republicans favor the two-step approach, prioritizing immigration and defense spending before addressing tax reform. House Republicans, however, insist on a single bill, fearing that tax reform might stall if the political honeymoon period ends. Trump's initial support for a huge and beautiful bill added fuel to the fire. Aligning with the House Republicans' single bill strategy, the divide has only widened, with the House Freedom Caucus, a group of far-right Republicans demanding a $2 budget cut for every $1 increase in spending. Senate Republicans, facing resistance to the comprehensive approach, are accelerating the two-step plan. They intend to pass $150 billion for border security and immigration enforcement, plus another $150 billion for defense, before dealing with tax cuts. House Republicans, realizing they will miss the deadline, are now in a difficult position. The outcome remains uncertain. If the single bill passes, it would be a significant victory for Trump's agenda. If Trump switches his support to the two-step approach, the House might be forced to compromise with the Senate. This ongoing debate reveals Republican concerns about the fiscal deficit, suggesting that pushing through tax cuts might be more challenging than anticipated. This uncertainty could dampen market optimism about Trump's economic policies. Investors need to be prepared for potential stock price volatility due to the ongoing wrangling over the tax bill. Another key takeaway involves Trump's evolving stance on the Federal Reserve. The current administration is reportedly more focused on lowering long-term interest rates than on pressuring the Fed to cut rates. Trump aims to achieve lower rates through policy measures such as deregulation, tax reform, and reducing energy prices. Their target is the 10-year Treasury yield, often referred to as the long-term interest rate. The message is that by cutting spending, reducing government size, and making the government more efficient, we will enter a favorable interest rate cycle. This suggests a focus on keeping long-term rates below 5% to prevent a collapse of Trump economics and a downturn in the stock market and other rate-sensitive sectors. The recent decline in long-term rates is likely due more to lower than expected CPI data than to Trump's policies. However, this focus on keeping long-term rates in check should be viewed positively by investors. It reduces one of the biggest threats to the U.S. stock market this year. Across the Pacific, the Bank of Japan is signaling a potential acceleration of interest rate hikes. A hawkish member of the Bank of Japan stated that rates should reach around 1% by the second half of 2025, requiring at least 2 more rate hikes before the start of next year. This statement was made against the backdrop of strong wage data in Japan, indicating a potential shift in the central bank's stance. Japan's nominal wages rose 4.8% year-on-year in December, the highest in nearly 30 years. This robust wage growth, coupled with the BOJ's view of a 1% neutral rate, points to a significant gap that needs to be closed through further rate increases. However, it remains unclear whether other central bank committee members will support this aggressive pace. The market is currently pricing in a high probability of another rate hike this year, most likely in July, but the strong wage data has increased the odds of an earlier move, possibly as soon as April. This development poses a risk to U.S. stock investors. If Japanese wage growth continues to be strong, the BOJ might be forced to raise rates faster and more aggressively. This could disrupt global carry trades, cause a repatriation of Japanese funds invested in the U.S., and trigger selling pressure. While Japanese interest rates are just one variable among many, investors need to monitor the situation without letting it overshadow other factors, such as corporate earnings growth. Finally, let's touch on some tech stock update. Wilday and ARM delivered better than expected quarterly results, but the market reaction was surprisingly negative. Both stocks fell sharply after the announcements, largely because they had already rallied significantly. The market had high expectations and even minor disappointments, such as slightly lower than expected intellectual property licensing revenue for Deerwood and a guidance that didn't exceed the most optimistic forecasts for ARM-triggered selling pressure. This highlights the alike set for chip stocks. If AI doesn't further boost their earnings growth, stock prices could face continued pressure. Tesla's sales in Europe plummeted in January. A number of factors contributed, including reduced government subsidies, but there is a theory gaining strength that relates to some actions taken by Elon Musk in the German political landscape. In Germany, Musk's public support for a far-right political party, a party considered taboo by the mainstream German political establishment, has reportedly alienated consumers. The situation bears the potential impact of a CEO's political stance on a company's brand and sales. Amazon's earnings report, released after the market closed, triggered a 5% drop in its stock price. The issue was primarily with the guidance for the first quarter of 2025. The company projected revenue growth that fell significantly short of market expectations, representing the slowest quarterly growth since Amazon went public. While Amazon cited currency headwinds as a factor, the market was clearly not satisfied. The report had some positive aspects, including strong growth in operating profit. However, capital expenditures surged, reflecting the company's heavy investment in data centers, AI chips, and other infrastructure. This beskews the ongoing commitment to AI, but the slower-than-expected growth in its cloud computing division, AWS, compared to rivals like Microsoft and Google, remains a concern. I believe that with cloud computing, ads, and retail profit, Amazon has strong and diverse profit sources, and I am still positive on Amazon's long-term performance. That near wrap for today. In-depth analysis. We covered a lot of ground, from AI competition and trade tensions to shifting interest rate strategies and individual stock performance. Remember to do your own research and consult with a financial advisor before making any investment decisions. Please like this video, subscribe to the channel, and leave a comment below letting me know what topics you'd like me to cover next. Thanks for watching Collin Investing, and I'll see you in the next video.